Just a bit of breaking news this afternoon. China has lifted the final sanctions on 2 Australian abattoirs, ending a host of tariffs on local goods from around 4 years ago. Now, Ed told you about the stock market roaring back to an all-time high, but the September quarterly national accounts tomorrow might just be a bit more sobering. Reuters estimates the annual rate will come in at about 1.1%. That compares with 1% in the previous quarter. Quarterly growth tipped to be 0.4%, better than the 0.2% in the June quarter. Adding to the drag on the economy, the last current account, or the latest current account balance, which measures money coming into the country versus money going out, recorded its sixth straight quarterly deficit, $14.1 billion, compared with estimates of $10 billion. Now, the drag from rising debt and higher interest rates is starting to show. Our trade with the world remains in surplus, but it was the lowest trade surplus since June 2018. The income deficit, that's the interest paid and the other money that's going overseas, that dropped $5.5 billion to $17.3 billion. So why is the stock market booming? Well, the economy quite clearly is just plodding along. Tony Brennan is the Chief Investment Strategist with the investment house Canaccord Genuity, joins me now. Can I just ask you, does the market know something with these all-time record prices that the economy is not showing right now?
It does feel like a bit of a disconnect, Ross. I think what we're seeing around the world is markets are pricing this soft landing that's taking place in the United States. And here we call it the narrow path. And the economy has stayed on a growth path, even though it's been a bit slow. As inflation's come down in the United States, it's done the same, but even stronger. And historically, normally getting inflation down has caused recession. So the outcomes have been a bit better than was feared. And after a couple of years when the market didn't do much, when rates were going up, it took off in the last 12 months as things started to look like they could turn out okay in preparation for better growth to come.
But you know and I know, we've been taught this all our lives, that stock markets basically move in anticipation of future earnings growth. Now, the reality is if the economy's flat, there's no earnings growth coming for many sectors. You can see it in the iron ore miners. You can see it in the retailers. You can see it in manufacturers right now. All of those sectors are struggling. They're under pressure. The construction industry, under pressure. So I'm going, for all these share price growth we're seeing, and you might argue the banks are still strong, that some of the tech companies are very strong, where's the earnings growth?
You're right. I mean, there isn't much earnings growth at the moment. I think for the next year or so, it's going to stay that way. So the market is really running ahead of itself.
So, OK, if it's priced for perfection, if it's running ahead of itself, does that raise the risk that it's overpriced and that if something goes wrong in the forecast or something goes wrong in the outlook, that this thing comes back to earth with a very big thump pretty quickly?
Yeah, that's definitely a risk if there's some left field development. The market does look very fully valued. The price earnings ratio, which in Australia is averaged about 15 times, is about 18. So that's about 20% above how it would normally price the earnings for the coming year. It's just dependent on those earnings recovering. If they take longer, the market will probably slow down for a bit. The returns will get more subdued. And if something goes wrong, they could be quite subdued, in fact, negative. So that's what's possible for sure. OK,
so is it part of the issue here that you've got all of these ETFs, exchange-traded funds, which follow the index? And so if the index is up, they have to keep buying. And if people keep putting money into these funds, those funds keep on buying the index. They keep on driving it up. Is that much of a factor in what's happening in our stock market right now? It
could be an element in the degree to which the market's gone up more than maybe justifiable. But the market is rational in the sense that with the narrow path we're on, we're going to get into a more sustainable position in the next 12 months where we can return to solid growth again. So the market's looking forward to that. It's just a fair way away.
Well, that's the problem, isn't it? Because it was all originally predicated on interest rates coming down. Now, you've got a lot of the major banks right now putting their first forecast of rate cuts in May, but that's no guarantee, set in cement, that that will actually happen. That's a part of the issue here. The interest rate cuts were supposed to stimulate the economy, get the animal spirits going, and the stock market was running ahead of that. The problem is, if the inflation's sticky, if something doesn't happen, then that could again spell danger for our markets.
Well, that's right. The growth is also coming from the fiscal policy, the budget, the government spending. So
it's spent a lot of money, as we know.
Yeah, so that's helping the growth, and households look like they're starting to spend a bit more after a fallow year or two. So those two things are lifting growth even without interest rates coming down. Interest rates coming down would certainly help, but inflation needs to be heading into the target.
So we'll see that tomorrow, in particular with the household savings ratio. We'll see that with the consumer demand, whether that's come back, given the fact that the consumer and the consumer's attitude is the biggest, strongest mover of our economy. So that's the key, isn't it, to try and get the households feeling better. But right now, with energy prices, with interest rates not moving, that sector's been pretty flat as well.
It has. I mean, you're right, household spending, consumer spending is the biggest part of the GDP. But it does look like it's getting a little better. We already know what the retail sales were like for the September quarter. They were up about 0.5%, which was stronger than we've seen for probably 6 to 12 months. Consumer sentiment's actually lifted a lot. Surprised me, actually. But I think the tax cuts, the subsidies on energy, the strong job growth still, the easing in inflation, real incomes rising, it's actually starting to lift household spending. Gradually, but it's starting to happen a bit.
And so, one thing, you can't discount a decent market fall, but really, it's not your main prognosis for the market, I would suggest right now.
Oh, no, I wouldn't rule it out. What I do think is we're going to see more subdued returns. In the past 12 months, our market here has been up over 20%. The US market's been up over 30%. I don't think that will continue. The returns will come down partly because, as you say, they've gone ahead of things. And also, I think the risk now is that overseas interest rates start to come up again because the new American president's going to spend.
It's going to be interesting to watch. Tony Brennan, many thanks for your time today.
Thank you, Ross.